Ladies and gentlemen, good day and welcome to Satin Creditcare Network Limited Q4 and FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. H.P. Singh, Chairman cum Managing Director of Satin Creditcare Network Limited. Thank you and over to you, sir.
Thank you. Good morning, everyone. Thank you for taking the time to join us and discuss our financial results for Q4 and FY23. I hope you went through our quarterly results and investor presentation. In case you couldn't, they are available on our website and stock exchanges. With great assurance, we would like to declare that FY23 has been a success not only in terms of meeting our annual performance guidelines and guidance, but also showing positive development in all operational and financial metrics, which would continue over the coming quarters and years. This year's performance is because of our dedicated and persistent team who are pursuing the collective goal of development of Satin. Let me begin by discussing the fourth quarter's performance this year, which was outstanding for us and featured strong performance across all parameters. Disbursement for the quarter stood at rupees 2,546 crore as compared to 1,622 crore in Q4 FY23, registering a growth of 57% year-on-year. This has been our highest quarterly disbursement ever. The profit after tax stood at rupees 94 crore as against rupees 60 crore in the previous year, a growth of 59% year-on-year. ROA stood at 4.9%, which was 3.3% in the previous year, and ROE at 20.3%, which was 15.5% earlier. This was our highest ever profitability. The cost to income ratio was 45% for Q4 FY23. With operating efficiency playing out for us, we observed a reduction of 90 bps in OPEX to average AUM in comparison to Q4 FY22. Our OPEX ratio stood at 6.1%. Coming to our annual performance, there was a substantial pickup in disbursements, which is up by 67% year-on-year at rupees 8,087 crore on a consolidated basis. The standalone disbursement for the year stood at rupees 7,390 crore, representing 83% growth from FY22. We have also started acquiring new clients. In Q4 FY23, first cycle clients accounted for 61% of standalone disbursements. We concluded a significant milestone by surpassing rupees 9,000 crore in AUM on a consolidated basis, up by 20% from FY22. The standalone AUM stood at rupees 7,929 crore, which grew by 24% year-on-year and 17% quarter-on-quarter. In the fiscal year, the company centered its effort on elevating the stress in the restructured book, and the figures speaks volume of results. The book has reduced to 2.5% as on book AUM. In the last 12 months, a total of 67 branches have been opened up, and we added 5,000 villages and a new state to our portfolio as part of our endeavor of deepening financial inclusion for the emancipation of the bottom of the pyramid. Coming to our Assam portfolio, with the support of our prudent approach, we are witnessing good ground and are optimistic of a turnaround in this geography. We have disbursed loans amounting to rupees 271 crore during FY23. The delinquencies in this book have been negligible, with PAR 1 at only 0.05% and PAR 90 at 0.01% as on 31st March 2023. The on-book AUM stood at rupees 326 crore, that is 5.8% of on-book AUM. Under MFIRS, Category 1 and 2 have been successfully completed. The groundwork for Category 3 borrowers, the sampling of data by Credit Bureau is going on. The asset quality and collection efficiency are testimony to the core strengths of our ground team and diligent assessment methodology. The new portfolio originated from July 21 onwards is performing exceptionally well, which constitutes about 94% of the on-book MFI portfolio, with PAR 1 at 0.7% and PAR 90 at 0.3%, which is better than the industry standard as reported by CRIF Highmark. This demonstrates how effective our underwriting processes are. The on-book GNPA of the company stood at rupees 185 crore, that is 3.28% of on-book portfolio, down from 8.01% as on March 22. Assam constitutes rupees 95 crore of on-book GNPA. Excluding Assam, GNPA as on March 23 stood at 1.70%. The company has sufficient on-book provisions. Our net NPA is 1.50%. The collection efficiency remains stable quarter on quarter for the reporting period and stood at 99.6%, excluding restructured portfolio. During the year, we experienced a strong recovery of rupees 48 crore against the write-off pool. This highlights the strength of our feet on street and their resilience towards business and their commitment towards recovering our bad loans by repeated follow-ups and client engagement and motivation. On the borrowing front, the company raised 6,846 crore during FY23 from various lenders, added 7 new lenders, demonstrating the confidence the market has in us and our business acumen. The company has ample liquidity of 1,029 crore as on Q4 FY23. Further, the company has a healthy CAR of 26.6% as on 31st March 23. Up to now, the company has received 137 crore out of 225 crore of preferential allotment via the issue of equity shares and full convertible warrants. Moving further, our performance at SCNL is constantly guided by our respect for strong business fundamentals, and we continue to focus on enhancing the quality of our balance sheet. And hence this year we recorded our highest ever profitability and delivered standalone PAT of rupees 264 crore, resulting in an ROA of 3.5% and ROE at 15% for FY23. In recent years, the social development goals have become the catalyst for accelerating the world's biggest challenges, ranging from poverty and gender inequality to climate change. We realized the importance a few years ago and thought it was crucial to embed the principles of sustainability in the rebuilding efforts. Hence, from there, we leveraged our CSR activities to achieve the Sustainable Development Goals. We are happy to share that we have been acknowledged for our work in the sustainability sphere and awarded by the Indian Social Impact Award 2023 for Best Education Support Initiative for the year 22-23. I would like to quickly touch upon a few awards and recognitions recently won by Satin Creditcare. We have been recertified by Great Place to Work 4th time in a row and ranked among top 25 best workplaces across the BFSI sector, being a testament to our work culture. We won the prestigious ET Excellence Award for Best Operational Excellence Initiative of the Year for Train the Trainers initiative, this being evidence to our robust operational efficiency. Along with the strong FY23 operational and financial performance, I would like to share a key development that took place this quarter, which is the merger of our two wholly owned subsidiaries, Tarashna and SFL. The merger got effective from 1st March 2023. Through unwavering adherence to our organizational values, we at Satin have always worked to establish a legacy of consistent growth and performance. We enjoy close, long-standing relationships with our stakeholders, which has led to brand trust that endures. With our robust operating model, proven execution capabilities, strong customer relationships, and a robust balance sheet, we are well positioned to demonstrate good growth in the years to come. Going ahead, we are expecting to achieve AUM growth of 25% plus and our ROA of 3.5% plus. Now let me run through the financial and operational highlights of our company, starting with the consolidated highlights. Our AUM as on 31st March 2023 stood at 9,115 crore. We have a customer base of 28.3 lakhs as of 31st March 2023, presence across 1,287 branches. Our disbursement for the year 2023 stood at 8,087 crore as compared to 4,856 crore in FY22. The total revenue for the year stood as 1,559 crores, up by 13% year on year. Pre-provisioning operating profit was up by 69% year on year at 414 crores. Standalone highlights. Our AUM 31st March 2023 stood at 7,929 crore. Our standalone disbursement for the year stood at 7,390 crore as compared to 4,031 crore in FY22. Our average ticket size of MFI lending for the quarter stood at 42,000 rupees. We have a well-diversified customer base of approximately 26 lakh clients, a well-penetrated branch network across 24 states and UTs, and 77% rural exposure. On-book GNPA reduced from 8.01% as on March 22 to 3.28% as on March 23. In absolute terms, it reduced from 412 crores to 185 crore. Out of this, 95 crore pertains to Assam. As of 31st March 2023, our total branch network count stood at 1,078 branches, which is spread across 384 districts. Sorry. We have a total state and UTs count of 24, which makes us a well-diversified pan-India microfinance player. As of 31st March 2023, 96% of our districts have less than 1% of portfolio exposure. Our top 4 states contribute to 55% of total AUM FY23 versus 77.3% in FY17. Our well-thought-out diversification strategy has enabled us to sail through difficult situations and capitalize on our idea of enriching our clients' lives through financing of various products. We have disbursed around 221 crore during FY23 under the product finance category, which includes loans for bicycles, solar products, home appliances, consumer durables, and water and sanitation. An update on subsidiaries. Satin Housing Finance Limited has now reached an AUM of 505 crore, which grew by 59% year-on-year, having a presence across 4 states with 5,448 customers. SHFL has a 100% retail book. The quality of the portfolio remains intact with GNP of 0.34% as on March 23. The company has 21 active lenders, including NHB Finance, a CAR of 45.3% and gearing of 2.3x. The company has a credit rating of BBB+. PAT for FY23 stood at rupees 6 crore. Satin Finserv Limited, the company's MSME and BC lending arm, has reached an AUM of 682 crore. GNP stood at 4.14%, CAR of 47% and a gearing of 1.2x. PAT for FY23 stood at 6 crore, credit rating of BBB+ stable. Lastly, as we continue the path of growth, we are prepared to the road of more profitability and cost efficiency. With this, I would like to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Congratulations, sir, on a strong set of numbers. Sir, I would like to know on standalone basis, what does the management think for the future when it comes to a comfortable debt to equity ratio, and also want to know if the management is planning on raising any more funds going ahead.
See, thank you so much for. So our CAR right now is at about 26.6%, and what we feel that, having a 25% growth, the guidance which we've given, we technically feel, I think, the pressing requirement, is probably not there for us to raise any more capital right now. And having said that, looking at the way the sector is growing and the way we are growing in microfinance, I think, for us, if we tend to overshoot this guidance of ours, then only I think it's a cause in the thing. We have a balance of about 83 crores which has to come in as our convertible warrants, which are due by July this year. And once they come in, I think we'll get maybe an additional slight more capital which will probably be infused. So for us right now, we feel that there is no pressing need for raising further capital.
Right. Just a number, if you could give, what is your comfortable debt to equity ratio on the standalone balance sheet?
We are at about 3 times our. It's about 4. Yeah. So it's about 3. We can go up to 4.5 basically. So we still have room for gearing across over there.
Fair enough. Thank you, sir. I'll join back in the queue.
Yeah, sure. Thank you.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Amit Agarwal, an independent investor. Please go ahead.
Yeah, hi sir. Congratulations on good set of numbers. Sir, my question is like we have written off so much assets in the last 2-3 years. So what is the total outstanding of written off assets we have in our balance sheet as on 31st March 2023? And based on our past experience, how much can we expect to recover in say next couple of years from that?
So, technically, if I start from the demonetization phase till now, my own senses are written off pool would be close to about 900 to about 1,000 crore. See, this is how we operate as a DNA of our company. We still go to a client who's been written off because of demonetization or anywhere which is talked about pandemic. We have had the highest write back, as I said in my opening remarks, of about 48 crores. Now, for us, we've got a separate team which looks only at write-off clients, and the endeavor always is to get as much as possible as write-backs, because this is a straight P&L, accretion which happens across over there. For us, going forward, we feel that we'll be able to at least manage about 48-50 crores year on year. That's the bare minimum. The endeavor always goes into get more and more. The teams are always fished into, contribute more towards that. And that's what our endeavor is, because having a separate team or a separate vertical which actually drives that, So my sense is a 50 crore is bare minimum. More than that, I think, we'll be happy to overachieve as we keep on overachieving everywhere else, We'll be there.
Okay, sir, one more question. Like earlier we used to maintain a lot of cash in our balance sheet. So how much cash and cash equivalent we are expecting to maintain going forward since the stress is now coming down?
Amit, what has happened is during the pandemic, I think, we were a little hard pressed that we wanted to probably be very conservative during those 2 years of pandemic. That's the reason why we had a lot of bank balances left. Moving forward, this is the first time in our entire history that we've remained close to that about 1,000 crore mark. We wish to probably be in the same range moving forward ahead, and this is which we feel is sufficient liquidity for us. If you look at the static ALMs which we've been able to do, we still have about 6 to 7 months of static ALM. So my sense is that gone are the days for us also when we used to keep a higher load of cash because of the pandemic and various other things which were going on. It'll be range bound, in what is there now as liquidity for 31st March.
Okay, that is helpful. Thank you so much. Yeah.
Thank you so much.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. Participants may please press star and 1 to ask a question. I would now like to hand the conference over to Ms. Aditi Singh, Head Strategy, for closing comments. Over to you.
I think, Vignesh, there are some people in the questions queue, so
I'll just take that.
take them.
We have a question from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Hello, sir. Yeah, thank you for the opportunity again. Yeah. Just to understand this unsecured MFI portfolio, so I've been tracking your company only for 3 months now. If you could just explain us the strategies ensure to put into ensure that the unsecured part of the portfolio goes down, because just if you could just explain some part of it.
You want to know the unsecured part of microfinance, basically? That
right, correct.
See, let me give you maybe since we have lesser questions to be asked, and let me just give you an insight into what microfinance is all about. See, it is a very dynamic business model. If you really ask me, I've put in about 30 odd years in this. It is unsecured by nature, but ultimately it has a lot of collateral which is attached because we follow the group model in terms of our working. Now, when you look at this, technically you've got 10 to 15 women who stand as a collateral guarantor to each other. So it's a moral and a peer pressure which works. In nature, it will be unsecured, but if you really ask me in terms of the joint liability which it emanates, I think it remains quite positive in terms of the peer collateral which is there. It's very gender specific. One, that is also a huge advantage, because if you look at women are normally financially far more disciplined than men. So the positive which is there, which people tend to kindly slightly overlook, I think is there, that it is peer collateral, it is gender specific, and it is probably in the rural space, which is far more insulated than the urban scenario in terms of the vagaries of what happens in terms of your activities or maybe the economic system which works in urban. So these are advantages which the microfinance portfolio has.
Okay. But this diversifying your unsecured portfolio by floating subsidiaries, I just want to know whether the holding company has given any guarantee regarding, has any guarantee or any sort of such things for any funds that is raised by your subsidiary, or it is, operating on its own?
No. So they are operating on their own. It's a complete set of separate dynamics. Since we are a parent, definitely, we stand over there in terms of business dynamic as such. Could be guarantee, could be comfort letters, could be, when they look at the parent company. I think, that's probably the way you should try and look at it. But these are standalone entities operating through their separate CEOs, through the separate business model rather, but definitely they do leverage the parents' legacy as such in terms of, how they have to grow. That is there.
Okay. And when it comes to expansion of branches, do you have any target in your mind for next year? I mean, just to understand more on the part whether the OPEX to AUM is going to increase from here on due to expansion, or we are done with expansion and we are more looking to stabilize around this limit.
Yeah, as I told you earlier, 25% growth technically happens without doing too much on OPEX. Our OPEX reduced in the last year. It has come down to 16.1%. So there's no question of any OPEX increase. In fact, it's going to be a decrease from here only, basically, moving forward.
And how much branch expansion are we seeing? If you could have some ballpark number.
Very, very few, about 50, 60, 70 branches. That's the ballpark number which is there.
Okay, fine. That's all from my side. Thank you, sir. All the best.
Thank you, sir. Thank you.
Thank you. We have our next question from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Yes.
Sorry, sir, your voice is breaking.
Hello, am I audible?
Yes, please go ahead.
Question.
I'm sorry, it's again cracking.
Is it okay now?
Yes.
Okay. Sir, question from my head.
I'm sorry, sir, it's cracking again. Are you using your handset?
No. Let me shift my. Hello, am I audible now?
Yes.
Two questions from my side. Could you provide any guidance for credit cost and cost to next 2 years?
We given a guidance for our ROA basically, which would technically include credit costs coming in. We don't have a separate guidance for credit costs. But let me give you just maybe a slight insight. The industry is talking of about close to about 1.5 to 2% credit cost. I think if the industry talks about 2%, I think we'll be also probably be better or maybe at their crossover. So that's my statement on this.
And on cost to income, if you could guide, sir, please.
Cost to income, again, if you look at it, we are down to about 45%. I think, we've covered a lot of distance from there. In any case, as the OPEX, as told the earlier question, was that, we are only looking at bringing it down as optimum efficiency and the denominator base of growth kicks in. I think the OPEX will also go down. So the cost to income ratio will technically also be on a downward trend.
Okay, that was it. Thank you, sir.
Yeah, thank you so much.
Thank you. We have our next question from the line of Lalitab Srivastava from Anvil. Please go ahead.
Hello, sir. Am I audible?
Yeah, you are.
Yeah. Good morning, sir, and thanks for the opportunity. Congratulations on a great set of numbers. My two questions are, first of all, if you can help us, how do you see the sensitivity of your lending rates or yield, as well as your cost of funds, especially in the present environment of interest rates, and what is the sensitivity of that rate hike movement? First thing. Secondly, if you can help us understand, sir, this, if I understand correctly, microfinance is generally a very touch incentive business. So it is, if I see your employees and other metrics, they have cost metrics also, they have trended down. So what differently you are doing here? The changes in the business mix, the business that you are doing on the ground side, if you can help us understand. So these are the two questions. Thank you.
So Lalita, the first question, the answer is, I think, we've had rate hikes which have happened. I think, they have already been done to a very large extent. There are no further rate hikes coming in. So definitely, I think the cost of funds, whatever it is, it will not now probably inch upwards. That's one. Secondly, in terms of us, I can say, not with certainty, but with a lot of confidence, with this set of results, which have been there, I think, we will have, at whatever point of time, maybe any kind of a rating upgrade or maybe an outlook which might change, which will also put, this in the positive category in terms of how the cost of funds are probably viewed on. So that's probably the answer to your first question. And the second question is, you talked about, sorry, what was the second question?
Yeah. So in the second question, I basically asked that generally MFI is a touch incentive intensive business. Your employee numbers has been kind of stagnant, or actually it has been trending down. You are seeing benefits on the cost side also, but I would like to understand, as a business, what different you are doing on ground, and how do you see that the implications of lower employee profile in the headcount, at least, panning out going forward on your business?
So if you've seen it, I think, we've increased our AUM, and the headcount has in fact gone down in terms of our field employees. Now this is probably what we had wanted to do since the pandemic finished off and we came into the being SI. So the optimum efficiency of the loan per loan officer, so borrowers per loan officer, is the optimum efficiency which we always target in terms of our this thing, including I think the various variables of how to increase the center size and all that. So I think the effort has probably gone on to that, and this will continue. So the optimum efficiency will technically move positive in that range, and this is how we've been able to achieve a better OPEX, a better operating efficiency, and a better profitability. I think this will keep on continuing, and this is our endeavor which moves on from here onwards.
Yeah, thank you.
Thank you so much.
Thank you. We have our next question from the line of Vishal Gajwani from Aditya Birla Mutual Fund. Please go ahead.
Hello, Mr. Singh.
Yes, morning.
Yeah, just wanted to know in terms of the business mix between, let's say, MFI and non-MFI, what we can see is that last 3-4 years, the non-MFI has gone up from 6.3% to 12.3% last year. How should one look at this business mix shaping up going forward?
So as a baseline, I think both the non-microfinance book, which is the MSME as a housing, has a lot of potential in terms of their growth. And we are moving slightly ahead. If I say that from 6% it has increased to 12%, I probably can maybe look at crystal rates for the next few years, as such, maybe the next 3-4 years. I think this will increase to probably about 20 to 25%. In the next 3 to 4 years, the mix will change, because technically what MFI has is a larger denominator base. So I think the growth over there, if you do a 20-25% increase there, and we have to do about 50% to keep it at par. So my sense is in the next 3 to 4 years will probably be in the range of about 20 to 25% overall AUM in terms of how these both subsidiaries are going to shape up.
Okay, sure. Thank you.
Yeah, thank you so much.
Thank you. We'll take a last question from the line of Suraj Navandar from Sampada Investments. Please go ahead.
Hello, hi, good morning, sir. Sir, what is our average cost of funds and average yield?
So, cost of fund has gone up slightly, but we are getting most of the funds in the range of some 11.5% to 11.75%. Lending rates are close to about 24.75 blended for the last quarter.
Okay. And have you been able to pass on all the rising cost of funds to our customers, or have we absorbed some of it?
We don't reprice our existing customer, but whatever we do it incremental on incremental lending. So this is how the industry has been working towards such a small loan. Repricing the existing customer is challenging on the ground. So this is how we do that. But our NIMs have improved over a period of time since the new portfolio is behaving fine. So yield losses are almost minimal.
Okay. And sir, answering to the last question, you said that the housing and the MSME group book will grow as a percentage of total AUM. But housing and MSME will have smaller spreads compared to microfinance. So can we expect compression in NIMs going forward in next 2 to 3 years?
See, the portfolio range which we look at and the the environment which we work both for MSME as well as for housing finance to a large extent is the graduated microfinance customer, which needs a higher ticket size in terms of MSME lending as well as a specific lending in terms of housing finance. Where the yields are not compromised or under pressure because of what you find in urban housing as well as in maybe the urban space. So this is predominantly rural, which is working in where the yields again range for this portfolio to a large extent within about 20% plus. So over there the pressure is not there, and moving forward ahead, I think when we talk about our housing finance, our average yield is about 15.5% to 16%, and similarly for our MSME it is close to about 21-22%. So the pressure is not there because we do rural and a graduated microfinance customer to a large extent.
Mm-hmm. So can you just throw a bit light on a broader perspective on the microfinance sector, because we are hearing a very strong commentary from other players as well, maybe the IIFL or Creditcare or you. So what has changed in the overall microfinance as a sector, and where this growth is coming from?
See, it has become more of, I think, two factors which are there. One, post the pandemic, I think the pent-up demand has really shot up in terms of income generation, which has happened of the rural GDP growing up as well as the rural economics in terms of businesses going on. That's one. The second is, I think, there is a larger penetration by the MFI players as such overall all across, and that demand is probably increasing with a larger penetration in each state, to a large extent. When we talk about, I can just leave one thought with you is that we're talking for about a 3 lakh crore plus industry right now. This industry is poised in the next 5 years to probably grow at least 4 times or 5 times higher than what it was. So that's the depth I'm talking about in terms of the microfinance sector's growth, which probably can be seen.
So you're saying the sector itself will grow 4 to 5x in next 5 years?
Yes, that's what my reading is.
Oh, okay. Thank you, sir.
Why I'm saying it, just to tell you, everybody's talking of a 25% growth year on year, and these are conservative numbers, which the industry talks about. But the depth of the market is that big. The penetration levels per state, if I tell you, the average would be about 15 to 20%. So there is a lot of room for microfinance players to probably have a solid growth in the next 4 to 5 years.
So then why we are not doing some aggressive branch expansion this year or probably next year? Because if sector itself is going to grow 5x in the next 5 years, then we should be ready probably this max by next year. So why are we not doing some aggressive branch expansion?
Boss, why is very easy to say, but you have to actually have a perfect asset quality as well as various other factors which will kick in. So it's not just about growth. It has to be various matrix of optimum efficiency, cost efficiency, credit cost, asset quality. Everything has to be taken into account. So you can only do what you feel is the best for the organization, and I think that's the reason why we set a guidance growth of 25%. And rather to probably do 100% then repent later on. That probably went wrong on that.
Yeah. So can we say 25% is a conservative guidance?
Well, kind of.
Okay. Thank you, sir. Thank you.
Thank you.
Thank you. That was the last question for today. I would now like to hand the conference over to Ms. Aditi Singh, Head of Strategy, for closing comments. Over to you.
Thank you. Thank you everyone who came on this call and they took out time. We have to right now conclude this call because there's a time constraint. I understand there are some people who still have questions and want to connect. Happy to connect with them offline, and my name is Aditi Singh. I head strategy. You can always reach out to me. You can always reach out to Ms. Shweta Bansal, who is DGM Investor Relations. We'll be happy to discuss, take your queries, and run you through any numbers or clarifications if you may. For now, we shall say bye-bye for now until next quarter. Thank you very much. Have a great day.
Thank you. On behalf of Satin Creditcare Network Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.